If you're in your 20s and 30s, there's a very good chance you've asked yourself this exact question. Should I focus on paying down debt or should I focus on starting to invest?
Yeah, and a lot of financial advice is pretty broad in general. Oh, pay off debt first, always. Or, oh, you should invest now because of compound interest. But it's a bit more nuanced than that. And as engineers, we wanted to make this an optimization problem.
Stop wasting money on that dumb shit and instead put it in investment. I know it's tempting. You'll spend it and be broke again.
All right, and starting off with just some of the simple math. At its core, the general rule of thumb is you should really just be comparing two interest rates: your debt and your expected return on your investment. Historically, the stock market has returned around 7% when accounting for inflation, but in recent years, that number is much higher. And if you don't take into account inflation, obviously those numbers are again much higher. In this video, we are going to be taking it into account because over time, inflation does have a more noticeable impact on your investment because you can essentially think as your effective rate being lowered each year. So if you have an investment that's going up at, say, a 10%, that curve is much steeper versus if it's effectively 7% each year, it does go up and you do get eventually a steep curve, but it's just a little less steep. So it's just a little bit of an outpace problem there.
Yeah, I love that. So if your debt interest rate is higher than when you're expecting to earn from your investments, mathematically it just makes sense to pay down that debt first.
Also nuance to that, but
For the most
the
part.
general rule of thumb.
90.7%.
And you'd have to invest when you're 0 years old for it to work.
Which I did, so losers. So basically, if you have a loan at 8% interest and you were to pay that off, that guarantees you 8% return. And there's no market volatility, there's no risk, it's just a guaranteed 8%.
But let's look at it another way. Let's look at a couple different scenarios here. Let's say you have an extra $500 a month available. Option A, invest it. Option B, use it to more aggressively pay down your existing debt. So let's start with option A, where you invested that money. Say you invest $500 a month into the market, getting an average effective return of 7% annually. After 10 years, you'd have $86,636. And for option B, all right, I'm locked. It will not happen again for the rest of the video.
It's a lot of pressure.
Not for me. And for option B, you apply that $500 towards a loan that has an 8% interest rate.
And in that situation, go ahead and let us know in the comments, what do you think's going to happen? We already kind of told you the rule of thumb, so based on that, what do you think? Drop it in the comments. Now let's continue the example.
So let's get very specific here. Say you have a $50,000 loan on a 10-year term with that 8% interest rate. Normally that'd be a $607 monthly payment, and in the end, you would have paid a total of $72,796.56. If you begin applying that extra $500 a month towards that, your monthly payment, of course, increases to $1,107, and you end up only paying a total of $59,688, essentially saving you just over $13,000, and you're able to pay it off in just 4.5 years.
And that right there should be a point in itself. That's not necessarily the point of this example or this video, but the fact that you can take that amount, that small amount, small relative, but small amount, and how big of a difference it can make on your, it saved you over $13,000, and it cut the loan term in more than half.
Yeah. That's
crazy. So just pay attention to that, take that point as it is, and again, let's continue the example.
So let's say at this 4.5 year mark, you start investing that $1,100 you now have freed up into the market and start getting that 7% annual return. At the 10-year mark, or 5.5 years in the future, you'll have a portfolio worth $88,857.98. Factor in that $13,000 in savings, and your total is $101,956.81. So the math shows that paying off debt worked out much better in this case.
And to be honest, we kind of expected that. Like the rule of thumb says, you're comparing the two interest rates and you're going to want to figure out the highest one. And in this case, that debt was higher, so you're going to want to pay it down because it's a guaranteed 8%, while in this scenario, you're only expecting to make 7%. That's a big deal. Makes sense. Quick rule of thumb. It's very handy. But there are some situations where that doesn't hold true, and debt is categorized differently. So let's go look and, as like engineers, categorize this out and make this make sense. So if we're looking at an interest rate of 8% or higher, this is what we'd consider high interest debt. Something like a credit card that can even get up to 30+%, or a personal loan that can get very high, and some private student loans even. You know exactly what we're going to say in this situation. This is the highest priority. Paying off debt wins. It just makes the most sense because that debt is so high. It's going to be crazy hard to make that amount of money in the stock market with this without just having a fantastic year. That you're going to want to go ahead and get that 8+% guaranteed interest.
Yeah, and not only that, but carrying a credit card balance is extremely detrimental because that's also hurting your credit score, which, as we've talked in previous videos, is kind of like your report card for being an adult. Determines a lot of things like your eligibility for loans, other credit cards, things like that. So there's really just no reason you shouldn't be paying off, especially credit cards, but any type of high interest debt.
Absolutely. And looking at that next range of about 5 to 7% interest, this is where it can get very tricky, very difficult with the math, and different nuances come into it, like psychological comfort. If it stresses you out a ton to have any kind of debt, obviously that's going to play a big role. How good your cash flow is. If you're hemorrhaging on one investment, it might not be a great idea to just also have debt somewhere else. So, and then your risk tolerance. If you have a very big family and you're just like, you know what, it'd be better, more comfortable, just pay off this debt. Again, that's where it gets gray, and these other factors might play a big role. However, we're talking about things like some student loans, we're talking about some auto loans, we're talking about mortgages, maybe even a good personal loan. There's just different loans that can be in this range. But this gets difficult because, again, on average, you're talking 7 to 8% return from the market. And at the same time, you're having your interest debt there that sometimes a year could be really good and it could outweigh that. Sometimes it'd be really bad and it would have made more sense to pay off the debt. So it very much depends on this situation.
So in classic engineering fashion, we decided to go into another example and dive into the numbers. So let's say, again, you have an extra $500 a month. You're trying to decide between putting towards your mortgage or an investment. So let's say you have a $400,000 mortgage. So that's after the down payment and closing costs and all that. And this is a 30-year term and it's at a 6% rate. Your monthly payment comes out to $2,398.20. So if you began putting an extra $500 a month towards it, your monthly payment would be $2,898. And in the end, you would save yourself $182,636 and you would shave 10 years and 5 months off of your term. So let's say at that point, you started investing that mortgage payment plus the $500 and started getting an average return of 7%. After 10 years and 5 months, you would have $531,703.58. So that portfolio plus your $182,000 in savings brings your total up to $714,339.58 at that 30-year mark. 10 years further down the line, your portfolio is worth over $1.5 million, and you still have that $180,000 in savings, bringing your total up to $1.75 million. But on the flip side, let's say you invested it from the very beginning. If you invested that $500 each month for a 30-year term, and you're getting an average return of 7%, at the 30-year mark, you would have $612,371.77. So comparing those numbers, your portfolio may be worth more, but once you factor in the savings, paying off debt actually outpaced it in overall value. But let's look 10 years into the future, where you've also been able to apply that full $2,898 a month. Your portfolio is worth $1.73 million, which brings the overall totals very close together. So you're like, okay, I guess paying off your mortgage and debt wins. Well, there's a bit of a nuance to this because you look further down the line, after just 2 years, your portfolio is worth $2,070,444.45 versus the paying off debt route 2 more years down the line. Your portfolio is worth $1,883,602.36. You factor in the $180,000 of savings, and your overall value is $2,066,238.36. So, given enough time, the investment route actually does surpass the debt payment route. And from there, your portfolio is already worth a greater amount, so you just have more and more time for that compounding interest to build on, and the gap actually increases a little bit. Now, you're already a multi-millionaire, so you're like, I could deal with it one way or the other. But it just goes to show that time is the most powerful part of investing. And one thing to note with that mid-tier debt, in our example, the loan term was very long. We were looking at a mortgage, but let's say you were looking at a smaller personal loan with a smaller term. In those instances, you don't have to wait as long for the investment to outpace it because the principal stays the same, but the timeline has essentially been shortened. And when you're young, that's a much bigger benefit to you because now you have even more time for that compound interest to kick in.
I tried to warn you guys. This was a number heavy video, but if you can read in between the numbers and understand what we're saying here, there's a huge message. And in this example alone, there's two big things to point out. One, this only works out to be this close if as soon as you pay off that debt of high interest, you move that plus the extra payment to the investment. It's the only way it gets close. And two is when you have them that close, we're talking about value. But actual portfolio in the end, the investment's going to be almost $250,000 more. And as time goes further on, it's going to be even greater because we're factoring in that savings, which don't get me wrong, is a huge, huge deal. But an actual investment portfolio, it starts to get further apart because that portfolio stays larger for longer. And that's such a big deal and such a big note to pay attention to as well. So last category we're going to talk about is that low interest debt. It's going to be that 4% and down, realistically that 2 to 4% range, because the only time you'll see that 0% is like an interest credit card or very intro, maybe a bonus for 15 months type thing, or at like a dealership and they're trying to really sell cars, so they'll do a 0%. Anything that low, you're expecting to make significantly more on the market or your investment, so it'd be way better to invest that money in 99% of cases than it would to be pay off that debt. Again, this is just strictly numbers and math speaking here. Let's look at that same $400,000 mortgage that Taylor mentioned earlier. And let's say you got it back in 2020, so it's sitting at a 3% interest rate. So your normal monthly payment is $1,686. If you applied an extra $500 a month, you would save $71,800 and about 9 years and 7 months of payments. Now let's say after you paid off that mortgage and saved that money, you took the entire $2,186 that you freed up and you invested that at 10% return, you'd have about $420,000. Take that $420,000, add it to that $71,800 you saved, your value is about $492,000 at that 30-year mark. All right, let's see if the rule of thumb still holds. If you invest at $500 a month for 30 years at that 10% return, you would have $1,140,000. It blew away those savings. So that's a huge, huge difference. So the lower that interest rate is, and the greater return you can get on your investment, the bigger the gap is on the outcome and why you should invest over pay down that debt.
So all that to say, what's the overall engineering framework we would lay out for us personally if we were in a situation like this? Well, we want to take advantage of those great investments like a 401k because if your company offers a match, that's free money. So any scenario like that, you do want to take advantage. But of course, if you do have some high interest debt, that needs to be your next biggest priority, especially if it's something like a credit card. Go ahead and knock that out of the way. And with the market volatility, you couldn't say with absolute certainty that you'd be able to outpace a debt that's, say, at 13%.
Right.
Now, there is a chance, but that risk there is just something that you really have to weigh. Now, back to the mid-tier. This is where things get a bit nuanced, like we said.
Yeah.
We were very conservative in our investment numbers. You know, a 7% return, we don't want to say is a guarantee, but is extremely likely and backed by numbers. I mean, over the last few years alone, the stock market has far exceeded that. That's why the general rule of thumb, and one that we implement in our lives, is since we're so young, we're able to take much greater risks. We're just much more risk tolerant. Now, if we were further on down the line, wife, kids, and we were nearing retirement age, this might be a bit of a different story. We're naturally a bit more risk adverse, so we might switch it up a little bit. But we have so much time, and time is the greatest asset towards investing because of that eighth wonder of the world, compound interest.
Yeah, and to Taylor's point, when you're that young and you have a higher risk tolerance, That means you could even go after a little bit more speculative, let's say, investments or higher growth investments. And so your average return can maybe be 8-9%. And that's on average after inflation. So that means that number or that rule of thumb we were talking about, a high interest debt, maybe it's not 7+% or 8+%. Maybe it's all the way up to 9 or 10+%. And that's just because you have so much time, you can go after bigger investments. And so again, that's a big change in this whole framework. But the numbers stay true. And for most people, the rule of thumb to sum up this whole thing is 8+%, because again, we're expecting you're going to make roughly 7% on average based on historical data. 8+% interest, you're going to pay off that debt. 5 to 7%, it's a little bit gray area, depends on your situation, depends on what's going on. And then anything below that 4 or 5%, you're typically going to want to invest in most situations. But please let me know you made it this far in the video. I know this was so heavy in the numbers, so many examples, but we thought it helped so much. And we sat down ourselves for hours going through this to make sure it made sense and it was helpful. So please let us know in the comments you made it this far. Please like this video, share with a friend, because it's a huge debate. We just had this debate last week because it's such a big deal. And as time goes on, as scenarios pop up, the debate happens all over again. So again, please like this video, share with your friend you're going to have this debate with, and then subscribe to the channel and stay tuned for next week's video.
Stop wasting money on that dumb shit and instead put it in investment. I know it's tempting. You'll spend it and be broke again.